Will investing in the ICICI Prudential Signature Plan help you grow your money as expected? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So some of the benefits of this plan is there are wealth boosters. So extra units will be credited to your policy at the end of every fifth policy year, starting from the end of the 10th policy year till the end of your policy term. So each wealth booster will be equal to 3.25% of the average of your fund value on the last business day of the last 8 policy quarters. Another benefit is they return your mortality and policy administration charges. So the amount equal to the total of those charges deducted in the policy will be added back to your fund value at maturity, but this is only for the whole life option. And they also give you life cover, which is applicable to the entire policy term to provide financial security to your family in case of your unfortunate absence. And this policy also allows you to withdraw a predetermined percentage of your fund value regularly, like systematic withdrawal plan, and there are partial withdrawal benefits for this. And they do have a whole life policy term, which means the policy term will be equal to 99 minus age of your entry. So these are some of the benefits of this policy. So some of the advantages is you have control of your investment, because this plan gives you the option to fund switch, because it is possible to move your money between equity, balanced and debt funds. And with this option, it is also possible to invest your future premium in a different fund of your choice. There is an option where you can withdraw a part of your money, but it comes with certain restrictions with different ULIP. So these are some advantages. Another advantage is there are significant tax benefits, like investment in ULIPs up to 1.5 lakhs per annum are tax free under the section 80C of the Income Tax Act, and death benefit is also exempt from tax under section 10D of the Income Tax Act. However, one point to note is the maturity proceeds are taxable under the conditions mentioned in the Finance Act 2021, but also it does not attract any tax while fund switching. So this is another advantage. Another advantage is more benefits in long-term investment. Depending on the policy you chose, it will have specific rewards and bonuses such as wealth boosters, loyalty additions, etc. So these are the advantages. The disadvantages are, first of all, the biggest disadvantage you could say is the returns in this policy are not guaranteed. For example, if you have chosen a ULIP that invests a large portion of money in equity stocks, and if the shares are not doing well, then chances of losing money are inevitable. So the returns are poor because there are multiple charges in this policy, such as mortality charge, annual maintenance charges, administration charges, etc. So these charges bring down the returns significantly. So in the first year itself, as high as 5% of the premium was lost in paying these charges. And there is also a lock-in period of 5 years where it makes the investor difficult to come out of this policy. And moreover, the policy also charges a discontinuance charge on the fund value. And under the Finance Act 2021, the maturity proceeds of the ULIP is taxable as capital gains if the annual premium in any year is more than 2.5 lakhs. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. And as I have already mentioned, there are various charges like fund management charge, policy administration charge, mortality charges and discontinuance charges. You need to pay certain amount from your portion of the premium, then only your net premium will be invested in the selected funds and strategies. So now, to take an informed decision, we need to analyze what kind of returns we will get from this policy. For that, we are going to calculate the internal rate of return of this policy, which is the IRR. So for calculation purpose, for an example, let us assume that a 35-year-old healthy male purchases this policy, and he is choosing 20 years policy term with a 10-year limited premium payment term, and he will pay an annual premium of 1 lakh for a sum assured of 10.5 lakhs. Then what are the ULIP returns in 20 years? So based on these speculations, the official ICICI Pru policy brochure suggests a maturity value of 27.11 lakhs at an assumed fund rate return of 8% per annum and 15.08 lakhs at an assumed fund return of 4% per annum. Now this looks fair, and the 8% CAGR is achievable by the equity funds of the ICICI policy. But the 8% CAGR does not mean that the investor gets the same investment return back. This may be confusing or surprising, but you can verify it in the IRR of the policy. In the tabular column itself, we have given a slight explanation. I will explain. As you can see, in both scenarios, 4% and 8% per annum, in that the actual IRR of this policy for the 8% scenario is 6.53, whereas for the 4% scenario is 2.67%. So while the 27.11 lakhs maturity value looks good, the net return rate from the policy reveals the truth. So the big difference in the return rate is because of the various charges that they charge you in this policy. Like every other ULIP, this policy presents one thing and delivers one another. In the best case scenario, the IRR of this policy is only 6.53%, and this return is something offered by fixed deposits and other assured return investment instruments. So this is not a good risk adjusted return. So when we take the inflation rate, which is 6 to 8% on average, into account, this 6% or even 6.5% return will be ineffective in the long term, and this is not even guaranteed. So hence, in reality, your investments will be losing value in terms of real return. Of course, this policy funds have delivered more than 8% as per the past performance, but the point is that the IRR of this policy does not deliver the returns earned by the fund, and it is wildly misleading the policyholders, because no matter how much the ULIP funds earn, the charges in this policy will drag it down by at least 2% on all returns. So this policy contains all the top-notch features that any ULIP holder would like to have, but if you choose to invest in ULIPs, you may be compromising on your most important financial goal. On the bright side, all hope is not lost. There are better investment alternative options available, which you are going to consider doing a comparative analysis now. So using the same metrics in the previous example, we have worked out a pure term and an ELSS fund combination. Here we are going to separately invest in insurance and investments. So a pure term insurance policy for life cover purpose for a sum assured of 10.5 lakhs will cost an annual premium of 6,800 rupees. The policy term is 20 years and the premium paying term is 10 years. The balance 93,200 rupees can be invested in the first 10 years and allowed to grow in the following 10 years. So here, as you can see, the 12% CAGR is a conservative assumption even for an average performing ELSS mutual, and the fund value at maturity is just shy of 51.10 lakhs. So it is almost double the fund value of ICICI Pru signature policy. Calculation tabular column you can see presented on the screen for your reference that we have calculated the post-tax return of mutual fund at 10.79%. So as you can notice from this example, the return of the ELSS mutual fund is still way higher than compared to the ICICI policy. So it is precisely 24 lakhs higher return than the ULIP. So some key highlights of ELSS mutual funds are there is only 3 years lock-in period, whereas there is 5 years for ULIPs in this policy, and there are similar investment risk as ULIPs, but it gives far better returns, like far better risk adjusted returns, and it has a much diversified portfolio than ULIP, and there are no hidden charges or any kind of charges like the ULIP, and there is also higher liquidity and similar tax treatment as ULIP. So it is noteworthy that despite the common belief that returns from ULIP policies are also taxable as per the amendment in section 10(10)(d) of the Finance Act of 2021. So if you take a look, who is more goal focused, mutual funds or ULIPs? You can see the financial goals are the basic building block of any financial plan. Though any ULIP is just practically impossible to achieve any financial goal due to their fixed lock-in period and lesser return on investment. But with mutual funds, you can list your short term like 2 to 5 years goal and long term 7+ year financial goals and invest accordingly in the right scheme, where you will be benefited from higher returns as compared to the ULIP. And if you take in consideration of the fixed lock-in period also, in this ICICI policy itself, there is a fixed insurance lock-in period of 5 years, and there are also cancellation charges which are significantly higher as mentioned in the previous section of the video. So if you want to cancel and come out from any mutual fund scheme at any time, comparatively you can do so much at a much lower cost as compared to ULIPs in the first year because there are no cancellation charges in mutual funds from first year onwards. And another thing to consider is the fund managers who are involved in managing mutual funds have strong pressure to perform the best among their various competitors. Otherwise, investors may withhold their SIPs and invest in other mutual fund schemes. Withdrawal of SIP may lead to the bad reputation of any scheme. This competitive nature of work tends to maximize the profitability of the mutual funds significantly. But with ULIPs, there is so much pressure among their fund managers as the returns are lower, plus there are 5 years of the lock-in period. Therefore, the fund managers handling mutual funds are highly competitive as compared to their ULIP counterparts. And if you take into consideration the regulatory authority, mutual funds are regulated by a reputed agency called SEBI, whereas ULIPs are regulated by IRDAI, which is basically something which regulates insurance policy. So SEBI ensures greater security and safeguards against all frauds in mutual funds or stock investment, whereas SEBI has no such role to play in ULIPs because IRDAI's regulations are predominantly focused on insurance regulation and not on the investment aspect. So SEBI's regulation is well evolved in regulating the investments, protecting the investors' interest, and proactively taking measures to stop mis-selling. So if your purpose is investing and getting better returns from this policy, then SEBI's regulation is better for you. And there is also better transparency available in mutual funds comparatively than ULIP about the fees charged and the portfolio. Also, there is transparency in the level playing field in the mutual fund investment, and the categorization of the mutual funds is defined by SEBI. For example, if you choose to invest in large cap mutual fund, your investment will be 100% in large cap, and you can easily compare various other large cap funds and select the best choice. Whereas the investment in the ULIP is rather complex. For example, if you choose to invest in large cap funds through ULIP, it is not 100% in large cap. They may be exposed to mid cap or other categories by 20%. Therefore, it becomes hard to compare one ULIP to another. The nature of ULIP investment is not transparent as compared to the mutual fund investment. And also, if you take in the affordability of insurance aspect, your investment in ULIP is divided among insurance and investment. So you can choose to pay as a single payment or on a monthly basis, and the minimum premium amount is 2 lakhs per annum. So existing term insurance plans comes with a much more affordable price as compared to the ULIPs and provide the same amount of benefits. You can earn way better returns in the combination of mutual fund and term insurance as compared to ULIPs, and you will have more control over your investments. So now, what is the final verdict? Should you invest in the ICICI Pru signature plan? So is this plan good or bad? Thing is, as we analyzed earlier on various aspects of this policy, this ULIP policy is not up to the mark. Do not invest in this ULIP. The insurance agents would convince you to buy this plan for their agent commission, so please beware. Our suggestion is to invest in mutual funds or PPF and term insurance policies separately. Not only will they provide you with higher returns and risk benefits, but it also takes away the limitations of any ULIP, including the ICICI Pru signature plan. And also beware of the mis-selling of this ULIP by your bank. They may lure you to invest in this policy by showing its various benefits. After watching the complete analysis in this video, we hope that you get a clear idea about this ULIP.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.